Welcome back to the MbaguMedia Finance Podcast. Today, we're diving deep into something that might sound technical but has massive implications for markets: benchmark revisions, especially concerning the upcoming non-farm payrolls report. It's not just about the monthly job creation numbers, it's about how the very foundation of that data is being adjusted, potentially reshaping our economic outlook.
Exactly. These aren't minor tweaks, they're significant recalibrations of historical employment data. Think of it like recalibrating a critical instrument on a spaceship mid-flight. The ripples are already being felt, potentially influencing everything from Federal Reserve decisions to the direction of the US dollar and the Dow Jones. Understanding these revisions is key to deciphering the true pulse of the economy.
Let's start by unpacking the mechanics. The Bureau of Labor Statistics, or BLS, conducts these revisions annually, typically in February. They compare their survey-based estimates with more comprehensive administrative data, like unemployment insurance tax records. This process corrects discrepancies and ensures the employment numbers we rely on are as accurate as possible.
It's a meticulous recalibration, aiming to smooth out sampling errors and capture structural economic shifts. While it might cause some initial market jitters, it's a testament to the BLS's commitment to data integrity. The goal is to build our economic narrative on the most solid foundation possible, even if that means retrospective adjustments.
Looking back, we've seen significant benchmark revisions before, and market reactions have varied. Sometimes they're minor, but other times they've necessitated a major rethink of recent economic trends. The market's response often depends on the magnitude and direction of the revision.
That's right. A larger-than-expected upward revision might initially spark optimism about economic strength, but it can also raise concerns about overheating or implications for Fed policy. Conversely, a downward revision can immediately trigger worries about a weakening economy, even if the current month's data looks positive.
The key takeaway from history is that while markets are forward-looking, substantial revisions that alter the perceived economic trajectory can be significant catalysts for movement. These historical episodes highlight the potential for data recalibrations to create short-term volatility as participants digest new information.
Now, let's talk about sectoral susceptibility. Certain sectors are more prone to adjustments due to high rates of business formation and churn. Think about leisure and hospitality, or professional and business services. These are dynamic areas.
If upcoming revisions show a substantial upward adjustment in these dynamic sectors, it suggests the economy has been stronger historically than we thought. Conversely, a downward revision in sectors like manufacturing or retail could signal persistent underlying weakness that monthly data hadn't fully captured.
The specific sectors affected will really dictate the narrative. A broad-based upward revision would paint a picture of robust, underestimated growth, while a concentrated downward revision might highlight more nuanced challenges. This granular understanding moves us beyond a simple headline number.
It's crucial to connect these revisions with other economic indicators. How do historical adjustments reconcile with current data like jobless claims or wage growth? If revisions suggest more jobs were created historically, but jobless claims remain elevated, it creates a puzzling divergence.
Exactly. It might imply that while overall job growth was stronger, the quality or stability of those jobs is less certain, or that labor market churn is higher. Similarly, if revised employment numbers suggest a less tight labor market than believed, it could impact inflation expectations.
The BLS methodology aims for consistency, but the interplay between these data sets can create apparent contradictions. Careful cross-referencing is key, acknowledging that no single data point tells the whole story. These discrepancies often require deeper investigation.
Then there's the surprise factor. The market develops expectations for the NFP report, but benchmark revisions are often less anticipated. If a revision significantly alters the historical backdrop, the reaction can be amplified.
For example, if the consensus expects 150,000 new jobs, but the revision suggests last year's average was actually 250,000, the market might immediately recalibrate its view of underlying economic strength. The potential for deviation from consensus driven by revisions is substantial.
This anticipation of how revisions might alter the established narrative is what makes these data points so closely watched. It creates opportunities and risks based on how effectively traders gauge the potential impact. It's a crucial element for market participants.
Now, let's shift to the March rate cut conundrum. Before even considering the benchmark revision's impact, probabilities for a March cut are already complex, shaped by Fed signaling and economic data. We track these via Fed funds futures.
These futures reflect the market's bet on future interest rates and are sensitive to every piece of data and every word from Fed officials. The crucial question is how a data shock from benchmark revisions immediately alters these probabilities.
If revisions are significantly positive, suggesting a more robust underlying economy historically, the market might erase March rate cut probabilities. For instance, if a 70% chance of a cut was priced in, a strong upward revision could drop that to 50% or lower.
Conversely, negative revisions pointing to a weaker past employment picture could bolster the case for a March cut, pushing probabilities higher. Quantifying this shock means translating perceived economic strength or weakness into rate cut expectations.
The Fed's dual mandate, maximum employment and stable prices, is central. Benchmark revisions speak to historical employment, but the Fed's policy is forward-looking. So, how do these retrospective adjustments weigh against current inflation trends?
If revisions suggest a historically tighter labor market, the Fed might worry more about wage price spirals, even if current inflation is moderating. Conversely, if they point to a looser historical market, it might give the Fed more confidence that inflationary pressures are subsiding.
Analyzing FOMC statements for hints on how the Fed accounts for benchmark revisions is key. Fed officials emphasize data dependency. But what does that mean when a core data set is being recalibrated? It creates a challenge for any central bank.
This uncertainty might lead to a more cautious Fed, perhaps hesitant to commit to a policy path until the data stabilizes. The market will try to anticipate how the Fed handles this ambiguity. It's a delicate balancing act between historical context and present conditions.
Comparing the impact of a revised jobs number versus a strong new jobs number on the March cut outlook is also crucial. Generally, the Fed looks at the most recent data and the forward-looking trend. However, a significant revision can alter the perceived trend.
If the new NFP report is solid, but the revision indicates consistently weaker historical growth, the Fed might still lean towards cutting rates. Conversely, if the new report is weaker, but the revision shows strong historical creation, the Fed might feel less pressure to cut. It's a complex interplay.
The role of wage growth revisions is significant too. Wage growth is a key inflation component. If revisions point to higher historical wage growth, it could reinforce Fed concerns about inflation, diminishing the likelihood of a March cut.
Conversely, downward revisions in historical wage growth could ease inflation concerns and support a cut. Visualizing average hourly earnings growth before and after revisions can be very illuminating here.
We also need to consider the Fed's red lines for inflation and employment. Regardless of revisions, if core PCE remains significantly above 2%, a March cut becomes highly improbable. Similarly, a sharp rise in unemployment would necessitate a cut.
However, with the current data, the focus is more on whether the economy is strong enough to delay cuts. The benchmark revisions will play a role in defining that perceived economic strength. It's about how the market interprets the Fed's flexibility.
Now, let's turn our attention to the dollar index, the DXY. It's a crucial barometer of the US dollar's strength and global economic confidence. Recent volatility shows its sensitivity to economic news and Fed policy shifts.
The correlation between US employment data and the dollar is well established. Historically, stronger US employment figures, including significant upward revisions, tend to support a stronger dollar. A robust job market signals a healthy economy, attracting foreign investment.
This increased demand for dollars strengthens the DXY. Think about the carry trade. If revisions suggest a more robust US economy, it reinforces the attractiveness of USD-denominated assets, potentially leading to a self-reinforcing cycle of currency strength.
On the flip side, if revisions point to a weaker past economy, this could fuel expectations of Fed easing. As we discussed, expectations of lower interest rates typically weaken a currency, putting downward pressure on the DXY.
Examining the DXY's reaction to previous NFP reports with significant revision components provides valuable historical context. We can observe past patterns to gauge the market's typical sensitivity to these adjustments.
The impact on U.S. Treasury yields is another critical link. An upward revision suggesting a stronger economy and potentially higher inflation would typically lead to higher Treasury yields. This makes dollar-denominated assets more attractive relative to others.
Overlaying the DXY chart with the U.S. 10-year Treasury yield chart can visually demonstrate this relationship. Considering the global context is also vital. How do U.S. revisions compare to labor market data from other major economies?
If U.S. revisions show unexpected strength while other economies show weakness, this further bolsters the dollar's relative position. This relative comparison is what truly drives currency markets. We also can't forget the risk-on/risk-off factor.
Does a data shock trigger a flight to safety, strengthening the dollar, or does it encourage investors to take on more risk if it signals underlying economic resilience? The dollar's behavior can be complex and depends on broader market sentiment.
The pivot for the DXY is whether it's positioned for a dollar strength narrative, perhaps driven by expectations of economic resilience, or if it's vulnerable to a downside surprise from these revisions, which could signal a less robust past than priced in.
Shifting our gaze to the Dow Jones Industrial Average, it's a proxy for the health of large-cap U.S. corporations and overall investor confidence. Its performance is intricately linked to the economic environment, corporate earnings, and interest rates.
Here's where the good news is bad news paradox becomes relevant. A strong NFP report, especially with upward revisions, could spook equity markets. Stronger employment often dampens hopes for imminent rate cuts, increasing borrowing costs for companies.
This can lead to sell-offs, even if the employment numbers themselves are objectively positive. Analyzing the sector-specific impact of revisions is crucial. Consumer discretionary sectors might benefit from stronger historical consumer spending power.
Conversely, rate-sensitive sectors like utilities might suffer if revisions reinforce expectations of higher for longer rates. The impact on corporate earnings expectations is a direct driver for stock prices.
If revisions imply a stronger past economy, forward-looking earnings forecasts might be revised upward. This positive earnings outlook is generally supportive for stocks, but it can be counteracted by concerns over interest rates.
The VIX, the fear gauge, can be an important indicator here. An unexpected data shock, whether positive or negative, can lead to increased market volatility, pushing the VIX higher. This increased uncertainty is generally not positive for the Dow.
The influence of bond yields on equities also directly impacts the Dow. If benchmark revisions lead to higher bond yields, this typically exerts downward pressure on equity valuations. The discounted cash flow models become less attractive.
Investor psychology plays a significant role too. Concerns about data reliability or uncertainty about Fed policy, amplified by these revisions, can affect overall risk appetite. This can lead to a flight towards safer assets, weighing on equities.
Comparing the Dow's sensitivity to employment versus inflation data is telling. In a rate-cut-sensitive market, implications for Fed policy often dominate. Employment data suggesting the Fed might delay cuts can be perceived negatively by the stock market.
The benchmark revisions will influence how the market interprets the strength of the labor market and, thus, its sensitivity to Fed policy. It's about whether the market is pricing in rate cuts or a no-landing scenario.
Let's consider corporate earnings more granularly. If revisions reveal consistently underestimated employment growth, it suggests consumer spending power has likely been greater than accounted for. This translates directly into higher sales volumes for companies.
This positive revision to the earnings outlook is typically supportive for stock prices. However, this can be offset if the market is more focused on the implications for Fed policy and interest rates, leading to higher borrowing costs.
If these benchmark revisions are substantial and surprising, it can introduce uncertainty that makes investors hesitant. This hesitancy can manifest as increased volatility and a general risk-off sentiment that punishes equities.
Investors might question the accuracy of current economic indicators if the historical backdrop is so prone to revision. This can lead to a flight toward perceived safe haven assets, which often benefits the US dollar but can weigh on the stock market.
The pivot point for the Dow is how the market reconciles these competing forces. Is it more focused on potential for stronger corporate earnings, or is it more concerned about the implications for Fed policy and a higher for longer interest rate environment?
The narrative that ultimately takes hold, one of underlying economic strength that necessitates caution from the Fed, or one of a potentially overheating economy facing headwinds from higher borrowing costs, will be the primary driver of the Dow's movement.
So, to wrap up, these benchmark revisions aren't just technical adjustments, they're a rewriting of our economic history. They challenge our understanding of past growth, inflation pressures, and labor market tightness.
For the Federal Reserve, it complicates policy setting, potentially altering the perceived urgency for rate cuts. For currency traders and equity investors, it forces a reevaluation of corporate earnings against evolving borrowing costs and market sentiment.
Ultimately, benchmark revisions are a crucial, albeit sometimes disruptive, mechanism for ensuring data accuracy. They remind us that economic analysis is an ongoing process of refinement, where today's numbers are built upon a foundation that is periodically re-examined.
Navigating this recalibrated landscape requires a keen eye for detail, an understanding of interconnections, and a willingness to adapt strategies as new, more accurate information comes to light. The signal from the labor market this month is indeed amplified.
And its true meaning will only become clear as we digest the full impact of these benchmark adjustments. Thanks for joining us on MbaguMedia Finance.
Thanks for having me. We'll see you next time.